Hello, everyone. Welcome to today's today's presentation, Mountain West IRA webinar. We have Jon Galane on with us, and he is going to be talking about asset allocation versus the alternative asset allocation, which is what you would use in a sense within a self-directed, or could use in a sense with self-directed IRAs, and actually still get the balanced portfolio. So I'll let you take it over from here.
Hi, I guess it's my turn to take it over.
Yes.
How's everyone doing today? Great. I'm sure you all said wonderful. Excited about all the incredibly interesting things going on in the world. So today's presentation is on asset allocation versus alternative asset allocation. And alternative asset allocation is a type of model that I invented back in 2006. Little did I know how incredible this thing was going to work. When I show you the presentation today, we are in absolutely unprecedented waters. Because I redo the presentation every so often, I redo all the numbers and update all of the numbers. And when I updated everything today, I was a little bit shocked at what's happened on my 30-year numbers and 10-year numbers with the past 3 years and what has happened to this alternative asset allocation model. And the numbers are going to be staggering. I'm going to warn you right now, when you see these numbers, you're not going to believe them. And I believe me, these are real numbers. Will they last like this? No way. They're too good to be true. It's like we're in some kind of wild Goldilocks investment portfolio dreamland. And so as I show you these numbers, you're just going to go, no, that can't be right. That can't be believable. Trust me, I'm showing you all of the mathematics involved in the numbers, and I'm showing you all of the graphs that are done by the Treasury Department and Case-Shiller and Dow Jones and Industrial Average. It's just a wild ride that it's like, I don't know when it's going to end or how it's going to end or what it's going to do. So let's go ahead and get started with this, because I have been working on it all day and rechecking my numbers, because I keep going, this can't be right. This just can't be right. So let's start with one of my favorite slides, which is one of my favorite dogs, Baroness. And I've kept this slide forever. Baroness left the world in 2000, I'm going to say maybe 2012, 2013. But she epitomized what happens in our government. And here is that little dog sitting up on that white hill, the shining white hill, and saying, "Hi, I'm from the government. I'm here to help you." Next slide. But I only need half of what you have there. And this is what happens to us when we're investing outside of IRAs or tax-deferred or tax-free type of vehicles. And when I say half, you're going, well, taxes aren't that high. They're, long-term capital gains are 15%, and top tax rates 36 right now, but you forget state taxes and you forget property taxes. And so once you add everything in, it ends up at half of what you have. And of course, they, look at you with those sad eyes, and just like you're doing them a favor for them to spend all your money on worthless things like investigations and pointing fingers at each other. Next slide. Thank you, but I'm going to need more. So what happens is, if you have investments and you're paying, and you've got income, you're paying that 50% on income, you're paying an additional 15% on 15% on investments, and with stocks and bonds, there's no kind of depreciation or write-off. On real estate, there is. And so people go, oh, if I buy real estate, I can depreciate things, I can write things off, da, da, da. And that's true, but you're not eliminating the the monster in the closet, which is the income tax that you're still paying. And so when I show you this presentation, understand that I built alternative asset allocation for retirement. So all of your assets stay protected from taxes while you're working. All of your assets are protected either by tax deferral or tax-free status, and nothing comes into effect on taxes until you start taking money out. And depending on how you've set it up, whether it's a traditional IRA where it's tax deferred and then you have to pay tax when you take it out, or if it's a Roth IRA where you take things out tax free, you can eliminate up to 100% of taxes, minus any borrowing you've done of other people's money to make what you're making. And I'm spending a lot up front because I know you're going to say these figures can't be right, because I went over them and over them again and again. I couldn't believe what's happened. Anyway, next slide. So here's the 4 villains that attack your estate and take away your net worth and your family's net worth and your family's ability to use what you worked so hard to make. First, yourself, because you're not investing. There's no condition in the world out there that the world hasn't experienced that you shouldn't be investing in. There's just none, zero. And I you can give me every excuse in the book, but I can show you figures 150 years back during World War I and World War II and the crisis in 2005 through 10 and this crisis, and there's just nothing that supersedes your own limitation or fear. When I walk around today, and I'm at a point where I've become very, for lack of another word, really pissed off. It's becoming very hard to walk around. I mean, I'm watching people with masks on in their car alone, like some virus is going to attack them and shoot out their window and choke them to death or something. It's becoming obscenely ridiculous. Now, don't get me wrong. I'm not saying coronavirus isn't real, and I'm not saying it's not a real threat, but it's just becoming nuts. So you yourself become your biggest threat to your own net worth by just fear and stagnation and not doing anything. Next is taxes. I talked about taxes a little bit. Third thing is inflation. Inflation is actually the first thing that I'm going to show you when I get into this, because inflation eats away little by little. It's like a little worm eating us away from the inside, and you don't even realize it. And then the fourth is allowing someone else to control your future. This is why self-directed investing is important, because you control your assets, you control how things work, and you're not dependent on a monstrous market that you don't have control of. You can decide when you're going to buy, when you're going to sell, and if you've got rental properties inside of your IRA, even if the market falls apart, you still have that income coming in to take care of that property. Unless, of course, we have the Black Plague and everybody dies off, and then you're stuck with a worthless piece of real estate with no renters because everybody's died. And, if you think that's a reality, there's nothing I can do to help you. Anyway, next slide. So here's the 30-year annual inflation rate. This is the highest 30-year annual inflation rate that America has ever sustained. I always tell investors, look at the 30-year inflation rate, because that's what that is, determines what you have to make above that in any 30-year period. And historically, inflation rates started in 1918 with the advent of the Federal Reserve Bank. And that's when they started controlling the money and monetary supply, and when rates started doing. But any 30-year period from 1918 you take through present was 3%. We are now at a historical point where inflation is higher the last 30 years than ever in the history of the United States. And 0.55% higher on a 3-year average is really a big deal. And it's really important that you're investing in things that are not going to be eaten away by inflation. Because this is the first time in my life when I've done 30-year annual average inflations, I've ever seen it above 3. So this is a big deal. If this is going to become our new norm, you better make sure that your portfolio is performing to eat up that extra 5% that's eating away at your assets. Next slide, please.
Hold on, I have a question here. So why is it looks like 2008?
Yep.
Like, can you explain why in 2000? Oh, that was the
That was the Great Recession. That's when interest fell through the floor, when Bear Stearns money market went below $1. It was just a horrid rate, and actually it everybody thought that we were going to have a negative interest rate year, and it didn't. It ended up very, very low, but it was almost zero, but not quite zero. Whereas this year we're in a negative interest rate year.
So is this graph basically showing that we're at a bigger depression or a bigger decrease than 2007-8?
No, bigger decrease in inflation. It doesn't show anything yet. There's no the inflation rate that's based on CPI. You've got to understand this first 2 quarters of the year, 40 million people were put out of work because of the COVID virus stuff, that businesses closed, that the consumer price indexes fell. I mean, but we don't know what the rest of 2020 is going to look like. So even though it's negative right now, it's negative through the end of May. This figure is as of the end of May.
Okay.
We don't know what's going to happen in the next 7 months. My guess is it won't be negative, but I guarantee it'll be zero. If it's not negative, it'll be zero. It won't be above zero because yield curves are inverted. I'm not going to go, that's a 2-hour explanation just on yield curves, inversions, and between short-term and long-term, but it's a mess. Just know that it's a mess right now, but that's why I always say look at the 30-year. Because even if we end up with a negative interest rate for this year, when you pull it out over 30 years, it'll change. Now, here is one thing though, if we have a minus, let's say a minus 5% or minus 0.55% this year, over 30 years, that'll bring it down from like 3.55 to maybe 3.52 or 1. But it's still, it takes a lot to get it to move. It took a lot to get it to move up. And it's kind of blew my mind because I went through the highest interest rate markets ever in the history of the United States in the 70s. During the Carter administration, all that stuff, when interest rates were 15 to 18%. So this is somewhat of a shocker to see this. This just happened in the last 18 months, where it went up to 3.55, 18 months using that 30-year average. So in other words, we had a low year drop off, whereas there was high years in the middle, and so it's a quantum shift, so to speak, in how you need to look at your portfolio and how important it is to look at things that can not just give you capital gain, but capital gain and income, because income keeps pace with CPI and inflation. Rental income, for example. So it's going to be very important when you look at your investments to look at the ability to overcome that 3.55 inflation, and renter income does that. Dividends don't. So either companies are going to have to figure out a way to raise their dividends hugely, like from 0.5 to 3% up to like 6%, to compensate. Because if you have a 6% dividend annualized and a 3.55 inflation rate, you've got a 2.45 dividend after tax. So it's going to take a lot of positive things would have to happen in the economy and dividends to get companies to be able to increase their dividends, in some cases almost by double.
Okay.
It's going to be very difficult. I know I'm harping on this, but this 0.55% increase is a big deal. Big deal. Anyway, next slide. All right, 30-year average on the Dow Jones. This is also an amazing figure. The Dow Jones Industrial Average over any 30-year period has been 10 to 10.5%. 10 to 10.5%. Think about that. They started keeping Dow Jones Industrial Average records in 1919. They had them before, but they started really tracking them 1919. So 10 years before the Great Depression. And there has been no 30-year average that's gone above 11%. Now, all of a sudden, this year, because some lower stuff has dropped off from the 80s, like 87, 88, 89, they kind of dropped off. So we're sitting at 90 through 20, and we've had these massive returns after the Great Recession. And it has pumped up the Dow Jones Industrial Average to 14.4%. That's huge. You're talking about almost a 40% gain over any 30-year period. That's huge. When you look at these, you go, wow, that's great. I'm going to show you that it's not as great as you think, but it is great. It's like, would I invest in the stock market looking at that 30 years? The answer is heck yeah, I would, but I certainly wouldn't put more than about 40% of my portfolio there, if that. And I'll explain why in a minute, and why it's important to diversify in these hugely markets. Sorry, I just have to use that term. For those of you that know what it is, that's great. For those of you that know what it is and hate it, don't hate me. Just the term is a great term for what's going on right now in the market. It has nothing to do with any human being. It's just amazing what's happening. Anyway, next slide. All right, so if I look at my asset allocation model based on current returns, now cash, which used to be a much higher model, and what I did is used a kind of a midpoint or a medium portfolio balance. What would be considered moderate is 10% in cash, 30% in bonds, and 60% in stocks. The 10% in cash, like when people put money in money market, now if you're trying to get money market now, you can only get about 0.2%. It's ridiculous, because I'm surprised that people aren't going to have to start paying money into their account to make up for interest. It's so bad right now. But over the last 30 years, it's been 1.6% return. And that's treasury bills is what that cash is. When you have a money market, they use treasury bills. So it's backed by the full faith of the U.S. government. 30% in bonds. Now, that is not government bonds. That's corporate bonds. And they've gone down about 50% over, if you took a 30-year period from 2 years ago, bonds have, because we had a terrible bond market and terrible yields from 2006 through 2016. And then they started to go up in 17, 18, and now they're worse than they were. So they're dropping at an incredible rate. So 30% bonds is corporate bond, and that's calculated 30% for the last 20 years. And stocks is 14.4%, which is just huge. It's amazing. So I'm sorry, I forgot to change the date. That Morningstar Ibbotson, it's actually, there's a different chart that I use now because Morningstar Ibbotson doesn't exist anymore. They were bought by somebody else. So I forgot to change that. But it's 1990 through 2020. Total return on $250,000 portfolio is $24,250. So $274, $250. With a pre-inflation rate, what's happened is cash and bonds are now dragging down the stock portfolios. And so you've got a pre-inflation rate of 14.1%. After 30-year rate of inflation, it's 10.55%, which is amazing because just 2 years ago it was 8.55%. So it's amazing what's happened on the 30-year average in just 2 years. It's shocking what's going on. And I attribute some of this, by the way, to the fact that everyone has such easy access to the stock market. And there's so much funds and so much in retirement, so much in pensions, that there's just so much cash going in. I remember the days when they said, oh, when baby boomers start taking money out of the stock market, it's going to crash, it's going to be miserable, you need to get out because $10 billion a month is going to be leaving and da-da-da-da. None of that's happened. The baby boomers retired and they didn't move their money out of the stock market. And yeah, they're taking some out for income and stuff like that. But it's easy to predict the end of the world. I've always said this, and Megan, I know you've heard me say this a few times. It's easy to predict the end of the world because when it doesn't happen, nobody cares. And that's what's happened to the market. Nobody cares that the end of the world was supposed to happen. So anyway, on the stock market, on asset allocation, you're looking at 10.55%. Next slide, please. All right, here is the model that I created, the alternative asset allocation model. We use the same beginning portfolio balance of $250,000. Only instead of cash, bonds, and stocks, I did first trust deeds, rental properties, and land. So about 15% in deeds, which give you consistent income, 40% in rental properties, 45% in land. Land, I'll go to that one first. Land is kind of like a higher risk stock. You could never quite know what it's going to do, but it averages on a 30-year, according to Case-Shiller, about 20% return. And I'm talking about undeveloped land that's lots, like it's been divided and been in lots. It's used for housing or it's being used for commercial development. I'm not talking about the median of a freeway. So that return is averaged about 20%. And you have some years it's 100% and some years where it goes down. It's just like a volatile stock. Land is. So, but remember, we're doing this allocation model over a 30-year period, which, by the way, I can't even get to up to 30 years because you wouldn't believe me if I told you the figures that far out anyway, the hundreds of millions of dollars that you would make. So since I know you wouldn't believe me, I just didn't even try to take it that far. I used to go out 30 years, but I can't because the figures are just too massive. Anyway, so first year return, you go from 250 to 317,000. Oh, let me go back to the rental property. Rental property is where you're putting 40% down. And I'm going to show you the Case-Shiller numbers right after this. It'll make more sense. But Case-Shiller figures out the growth in values of properties. It goes past, like it goes all the way back about 100 years. I'm only using 30 years. The reason I'm only using 30 years is on all this stuff. I used to laugh about it. The only model that existed before the internet was the Ibbotson model. And the Ibbotson model went from 1919 to whatever the current year was. And I used to laugh and say, unless anybody's been investing since before the Great Depression, it doesn't do much good for you to be over 40 years. Ooh, can you hear me?
I can hear you.
Oh, there I am. I thought I cut out. So I use 30 years because a lot of things can happen in 30 years, and it gives you a nice balance of what's going on in the economy, what's going on with investments. So pre-inflation, the rental property is 40% down, 60% loan to value. 45% down. But what's happened under Case-Shiller is the returns are, here it is again, hugely. You think the stock market was big. Returns on these are running at about 30 to 32% on housing over the last 30 years. It's massive what's happened. So, and then you add in the fact that you're using other people's money to buy that. So 60% is other people's money. it increases that return on investment to 40% on a rental property, because of using other people's money inside of a tax-free vehicle. And then the first trust deeds at about 12%. So that gives your first year return 317 minus the 250, about 74, 75,000, right about there. Anyway, pre-inflation rate is 46, and after inflation 42.5. It's actually 42.45. So I used to use pre-inflation rates to show these, just to show the growth, and not take into account. But the numbers are so big that I had to add inflation in just to make them more reasonable. So it's true numbers after current 30-year inflation rate. Next slide, please. So here's the Case-Shiller Home Price Index. It averaged 400% return from 1990 to 2020. 400%. That's unbelievable. That's just incredible growth, even through the Great Recession. And this is trading economics hit an all-time high of 230 in May of 2020. Next slide, please. 1990 was 50, 2020 230 on the index. It's a total gain of 400%, an average annual gain of that is an incorrect figure. That's 30. I screwed that figure up. I have to correct that, but it was actually 30. Hold on, I'll tell you what it was. Oh no, I'm sorry, that is correct. It's 13.3% average annual over 30 years, which is enormous because it used to run at about 6.84. So it's double. It's the annual average is double what it ran prior to 2006. The 30 years prior to 2006 was 6.84% cash on cash. Now we're averaging from 90 through 2020, 13.3%. So it's 100% greater return on investment just on cash to cash before you add in loans. Next slide. Okay, so I'm going to use something called Rule of 72. Rule of 72 was discovered by that brilliant physicist, Albert Einstein. And it's a very simple rule. And it gives you a basic look of what happens to your money based on what you're earning, how quickly you're going to double your money. It's the perpetual motion of money. And it's by keeping money at work in investments, how you double it year over year. So it's very simple. It works like this. On 10.55%, which was our stock portfolio, after inflation, in year one, the first going from 250,000 to 500,000 took 6.82 years based on the 10.55. And then it reached $1 million in 13.64 years and $2 million in 24 years. Not bad, right? Well, now let's look at the alternative asset allocation model using trust deeds, rental property, and land. Go ahead, Megan. So 72 divided by 42.5, which was our total after inflation rate, total inflation rate of a rental property with loans and land and trust deeds, is 1.69 years. So it would double every 1.69 years. So 250,000 is worth 500 in 1.69 years and $1 million in 3.38. So let's take it out. Sorry, not 18 years, 14 years. So 5 years is 2 million, 6 3/4 is 4, 8.5 is 8 million, 10.14 is 16 million, 11.83, 32 million, and 13.5 years is $64 million. Now, that 11.83 year or that 13.52 years is the same as the stock portfolio that's worth 2 million. I told you wouldn't believe this. So, and people say, well, how can you How can you justify that? How can you prove it? Here's the easiest way for me to tell you to do it. Use the alternative asset allocation model. Self-direct your IRAs. You don't have to self-direct all your stuff, but self-direct your IRAs. And you can leave stuff in the stock market and self-direct and do the portfolio, the alternative asset allocation portfolio, and use a program that gives you net worth. So, like for instance, I use Quicken. My business uses QuickBooks, but I like Quicken because it's simpler, and it's a very interesting thing. Is I put all of my properties in, I put all my liabilities, I put everything. It's every asset, every liability, every piece of real estate, all my rents, everything goes in there. And I have a graph where I can look at it daily, weekly, monthly, quarterly, annual, whatever period I want. I can look at the graph and see what's happening. That's kind of fun to look at, just see where things are going. But the bigger thing is if you've used one of these programs like Microsoft Money or Quicken or anything like that, you know that all of your columns go downward. And the last column, at least I know this is the way it is on Quicken, I'm assuming Microsoft Money is the same thing. That last column is net worth. Sorry, that was Baroness barking from the grave. So the last column is your net worth. And what I do is I take a copy of that every year. And so I can look back at my net worth. I started doing that in 2000, I believe 2005 or 2004 was the first year that I started using Quicken and doing that net worth calculator. And I've watched this alternative asset allocation model work. I've now lived it. And let me tell you what living it does. If you work harder the first 5 years at putting investments together and working hard and making that money and getting it working for you, if you work harder than anybody else you know for that first 5 years, you'll live like nobody you know can for the rest of your life. So that's why I think it's so important to look at an alternative asset allocation model and look what's happening in the markets. In 30 years, is this going to be the same? No. It's probably either going to be higher or lower. We don't know which way. But make an assumption that everybody's wrong, so you might as well just go make it anyway. Because nobody cares if we don't all die. And with that, I conclude. The alternative asset. Okay, what's the next slide? Let me see the next slide. I know I've got something else on here.
Nope, that's all.
Nope, that was it. So that's my presentation for today, and the importance of not listening to nobody, because nobody knows what's happening. I remember when that fool Kramer was on whatever his show is on CNBC in 2006 with a helmet on, saying, no, actually it was in 2006. It was 1996 when the .com bubble broke. And he's got a helmet on and he's hiding under the desk and going, the markets are going to zero. The NASDAQ's going to zero. Dow, sell everything. And I'm thinking, what are you, insane? It's like, don't listen to these people. They're entertainers. They don't know anything. Just go out and do it. Now I conclude.
Okay. Thank you for joining us today on our Facebook Live. You can catch the replay on our Facebook page at Mountain West IRA, or within the next couple days, you will catch it on YouTube as well. If you have any questions, comments, or want to ask any questions, you can call us at 866-377-3311. or email us at accounts@MWIRA. Thank you for coming on today. And that was a great lesson full of great information. So thanks.
Thanks. Goodbye.
Bye.